My dear students, welcome back to our channel. In this video, I will be explaining the Bachelor of Commerce 6th semester subject Accounting Standards as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 2. The important short question is: 1. What are the objectives of AS 10? White heavy check mark. What is AS 10? AS 10 is an accounting standard that deals with fixed assets. Fixed assets are things like buildings, machinery, or vehicles that a company uses for long-term purposes. Objectives of AS 10. 1. Proper recognition. AS 10 ensures that a fixed asset is recognized and recorded correctly when a company buys or builds it. Example: when a company buys a machine, AS 10 makes sure it's recorded properly in the books. 2. Measurement of cost. It ensures that the cost of the asset includes everything necessary to get it ready for use, purchase cost, installation, etc. Example: for a car, the cost includes buying price, delivery charge, and insurance. 3. Depreciation. It helps in calculating how much value of the asset gets reduced over time, called depreciation. Example: if a computer is used for 5 years, AS 10 helps in calculating its reduced value. Easy tip to remember: AS 10 is equal to recording, measuring, and depreciating fixed assets. Next important short question is: 2. What is the scope of AS 10? AS 10 covers the accounting treatment of fixed assets, like land, buildings, machinery, etc., that are used in the production or supply of goods and services. It applies to both tangible, physical assets, and intangible assets, like patents. Scope includes: 1. Acquisition of fixed assets. AS 10 guides how to record the purchase of fixed assets. Example: when a company buys machinery, AS 10 explains how to calculate and record its cost. 2. Subsequent costs. It covers how to handle costs incurred after buying the asset, like repairs or improvements. Example: if a company spends money to upgrade its machinery, AS 10 tells how to treat it. 3. Depreciation. AS 10 outlines how to calculate the depreciation, the value lost over time, of assets. Easy tip to remember: AS 10 is equal to covers purchase, costs, and depreciation of fixed assets. Next unit 2 important long questions. First important long question is: 1. Write in detail in AS 1, presentation of financial statements. What is IND AS 1? IND AS 1 is an Indian accounting standard that provides rules for how financial statements should be presented. Financial statements include important documents like the balance sheet, profit and loss account, and cash flow statement. The goal is to ensure that financial statements are clear, consistent, and easily understandable. Key objectives of IND AS 1. 1. True and fair view. IND AS 1 ensures that financial statements reflect the true and fair view of a company's financial position. 2. Consistency. It ensures that accounting methods are consistent across periods, making it easier to compare financial data year after year. Main requirements of IND AS 1. 1. Components of financial statements. IND AS 1 outlines the basic components that must be included in the financial statements. Balance sheet shows assets, liabilities, and shareholders' equity. Statement of profit and loss shows the company's revenues and expenses. Cash flow statement shows the movement of cash in and out of the company. Notes to accounts gives detailed information to explain the numbers in the financial statements. Example: a company like Tata Motors will have a balance sheet to show assets like vehicles and liabilities like loans. 2. Materiality and aggregation. IND AS 1 says that financial statements should include all important material information, but things that aren't significant can be grouped together. Example, if a company has many small expenses, they can group them together under other expenses rather than listing each small cost. 3. Comparative information. IND AS 1 requires that companies provide comparative information from previous periods so users can easily compare current and past performance. 4. Going concern. Financial statements must assume that the company will continue operating in the future unless there's clear evidence it won't. Easy tip to remember. IND AS 1 is equal to clear, consistent, and complete financial reporting. IND AS 1 ensures that companies present accurate and reliable financial information in a way that's easy to understand and compare over time. Next important long question is: 2. Explain cash flow statements as per AS 7, modified as 3 as 7. What is a cash flow statement? A cash flow statement shows the movement of cash in and out of a company over a specific period. It helps users understand how a company generates and uses cash. This is important for investors, lenders, and managers to make informed decisions. AS 7 and cash flow statement. AS 7 is an accounting standard that focuses on construction contracts. The modified AS 3, now AS 7, explains how to prepare a cash flow statement specifically for companies involved in construction activities. Key components of cash flow statement as per AS 7. 1. Operating activities. This includes cash flows from the company's main operations, like the construction work they do. For example, cash received from customers for a construction project or payments made to suppliers for building materials. Example: a construction company may receive cash from a client for building a bridge. That cash will be recorded under operating activities. 2. Investing activities. Cash flows related to the purchase and sale of long-term assets like land, buildings, or equipment. These activities are not directly related to the core operations but are important for growth. Example: the company sells an old crane for cash. This would be recorded under investing activities. 3. Financing activities. This includes cash flows from raising money, like issuing shares or loans, or repaying debts. Example: a company borrows money from a bank to fund a new construction project. This will be recorded under financing activities. Why is AS 7 important for construction companies? For construction companies, project completion can take months or years. AS 7 helps in showing how cash is used at different stages of the project. It helps in managing the cash flow properly to avoid problems. Easy tip to remember: cash flow is equal to operating, investing, financing. For construction companies, cash flow is all about building cash through project work, buying, selling assets, and getting funds for growth. This is how the cash flow statement is structured under AS 7. Next important long question is: 3. Explain about IND AS 101. Discuss how Indian accounting standards adopted first time. What is IND AS 101? IND AS 101 is the Indian accounting standard that guides how companies should transition from old Indian GAAP, generally accepted accounting principles, to IND AS, Indian accounting standards. It is like a roadmap for companies to make sure their financial statements are compliant with the new set of rules. Why was IND AS 101 needed? India decided to adopt Ind AS to align with global accounting practices and make the financial statements more transparent and comparable with international companies. This helps in attracting foreign investors and improving the credibility of Indian companies worldwide. Key aspects of Ind AS 101. 1. First-time adoption of Ind AS. When a company adopts Ind AS for the first time, it needs to follow specific rules to ensure the transition is smooth and accurate. Ind AS 101 sets out the procedures for how to prepare financial statements during the transition period. 2. Adjustments on transition. Under Ind AS 101, companies may need to make adjustments in their financial records to reflect the changes from the old GAAP to Ind AS. These adjustments could involve changes in how assets, liabilities, and income are recognized or measured. Example: a company might have previously not recognized certain liabilities under old GAAP, but with Ind AS, it might have to include them as per Ind AS 37, provisions, contingent liabilities, and contingent assets. 3. Comparative information. The company must present comparative financial information for the previous period based on Ind AS, so users can easily compare the company's financial performance and position over time. 4. Exemptions and optional exemptions. Ind AS 101 allows companies to use certain exemptions when adopting the new standards. For example, companies can choose not to apply fair value measurement for certain assets during the transition. How did Indian accounting standards adopt first time? The adoption of Ind AS began in April 2016 for large listed companies. The Ministry of Corporate Affairs, MCA, under the guidance of the Institute of Chartered Accountants of India, ICAI, issued these standards. Companies were given a transition period to adjust their financial statements to align with Ind AS. Easy tip to remember: Ind AS 101 is equal to smooth transition from old to new accounting standards. This way, Indian companies could adopt international best practices while still being true to their local needs. Next important long question is: 4. Explain about Ind AS 10, events after the balance sheet date. What is Ind AS 10? Ind AS 10 deals with events that happen after the balance sheet date but before the financial statements are approved for release. These events can either provide additional information about conditions that existed at the balance sheet date or indicate new conditions that arise after that date. Ind AS 10 helps companies decide how to treat these events in their financial statements. Types of events under Ind AS 10. 1. Adjusting events. Providing additional information. These are events that give more information about conditions that already existed at the balance sheet date. The financial statements should be adjusted to reflect these events. Example: if a company's customer goes bankrupt after the balance sheet date, but the company was already aware that the customer was facing financial trouble before the balance sheet date, the company should adjust its accounts to reflect the bad debt. 2. Non-adjusting events. New conditions. These events don't relate to conditions that existed at the balance sheet date. The company doesn't need to adjust its financial statements for these events, but they should be disclosed in the notes if they are significant. Example: a fire destroys a company's factory after the balance sheet date, and the fire wasn't anticipated. The company doesn't adjust the balance sheet but will disclose this event in the notes to give users of the financial statements an understanding of the situation. Key requirements of Ind AS 10. Adjust financial statements. If an event after the balance sheet date provides more details about an existing condition, adjust the accounts. Disclosure: for non-adjusting events, provide disclosures in the notes so that users know about any significant developments. Why is IND AS 10 important? IND AS 10 ensures that financial statements reflect all relevant events, even if they occur after the balance sheet date, ensuring that users get the most accurate financial picture of a company. Easy tip to remember. IND AS 10 is equal to adjust for old info, disclose new info. IND AS 10 helps companies stay transparent and informative to users of financial statements. Next important long question is 5. IND AS 24. What is IND AS 24? IND AS 24 is an Indian accounting standard that requires companies to disclose information about their related parties and any transactions with them. Related parties could be people or companies that have a close relationship with the business, such as family members, subsidiaries, or other companies controlled by the same group. Why is IND AS 24 important? The purpose of IND AS 24 is to ensure that companies disclose any transactions with related parties that might affect the financial statements. Without this standard, it would be hard for investors and users of financial statements to know if a company is doing deals that might not be in the best interest of all shareholders. Key requirements of IND AS 24. 1. Identification of related parties. Companies need to identify who their related parties are. This includes family members of key management, entities controlled or significantly influenced by the company, key management personnel, example, directors, managers. Example: if the CEO of a company owns a large share of another company, that second company becomes a related party. 2. Disclosure of related party transactions. Companies must disclose transactions with related parties, such as sales, purchases, loans, or management fees. Example: if a company sells goods to a subsidiary, it must disclose the price, the terms of the sale, and the relationship between the companies. 3. Details to be disclosed. The disclosures must include the nature of the relationship, amount of transactions, any outstanding balances at the end of the period. 4. Avoiding conflicts of interest. By disclosing these relationships, companies ensure they are not hiding any transactions that might benefit one party unfairly. Easy tip to remember. IND AS 24 is equal to transparency with related party transactions. By following IND AS 24, companies make sure that all related party dealings are open and honestly reported, so everyone can trust the financial statements. Next important long question is 6. What is IND AS 34? IND AS 34 is an Indian accounting standard that provides guidelines for companies to prepare interim financial statements. These are financial statements prepared for short periods of time, such as quarterly reports, rather than a full financial year. The goal of IND AS 34 is to ensure that interim reports are consistent, useful, and provide relevant financial information to investors and stakeholders in between the annual reports. Why is IND AS 34 important? Interim financial reports help stakeholders, like investors, analysts, and creditors, understand how the company is doing during the year, instead of waiting for the full year-end report. It gives them real-time insights into the company's performance and financial position. Key requirements of IND AS 34. 1. Preparation of interim financial statements. The interim financial statements should include balance sheet or a condensed version of it, profit and loss account, also called statement of profit or loss, cash flow statement or condensed version, changes in equity if necessary, These statements should be prepared similarly to annual reports but condensed, focusing on the most important financial information. 2. Comparative information. Interim reports should also include comparative figures from the previous interim period, quarter or half year, so that users can compare performance over time. Example: if a company prepares a quarterly report for Q1, it should also show data for Q1 of the previous year so that investors can compare the results. 3. Accounting policies. The accounting policies used in interim reports should be the same as those used in the annual financial statements, unless a change is necessary. Any changes in accounting policies should be disclosed. 4. Disclosure of significant events. If there are any significant changes, such as new contracts or business operations, these must be disclosed. This helps users of the financial statements to understand the reasons behind the changes in numbers. Example: if a company launches a new product line, this event should be disclosed in the interim report. Easy tip to remember. Ind AS 34 is equal to quick, clear, and honest reporting of financial results in between full year. Interim reports keep everyone informed quarterly or half-yearly, giving stakeholders the latest picture of the company's financial health. I hope you understand easily each question. All the best, students, for your upcoming exam. For other subject quick revision. Important questions. Previous question papers. And syllabus. Links are available in description. Check out once. Thank you for watching. Like and share this video with your friends.